The importance of finance to the project managers. Understanding finance for project managers. Having a solid foundation in financial principles allows project managers to accurately estimate costs, allocate resources efficiently, and track expenditures. Project managers can avoid overspending, minimize financial risks, and ensure project profitability. What does a project manager do in finance? The responsibilities of PMs include creating budgets, monitoring spending, preparing reports for upper management, analyzing discrepancies, and finding ways to stay within budget. Because budgets underpin every business decision, these professionals must have a keen understanding of finance and accounting. Duty and responsibility of project manager. It is the responsibility of a project manager to negotiate the right budget with the client and complete the project within it. As a project manager, you need to monitor the project scope, schedule, and resource requirements closely, as these changes can directly affect the overall cost of the project. Duty and responsibility procurement manager. A procurement manager is responsible for overseeing the purchasing process, ensuring that an organization acquires goods and services at the best value while maintaining quality standards. They manage supplier relationships, negotiate contracts, and develop sourcing strategies that align with project's budget. Project budgets. A project budget is the total projected costs against the income needed to complete a project over a defined period of time. It's used to estimate what the costs of the project will be for every phase of the project. The project BASH budgeting process involves the following: budget planning, estimating costs and making a budget based on a project estimate; budget tracking, keeping track of project expenses in the project execution phase; project budget management, setting guidelines and control procedures to guarantee that costs don't exceed the project budget. The importance of project budgets. The projects cost money. The project budget is the engine that drives your project's funding. It communicates to stakeholders how much money is needed and when it's needed. Project budgets are important for any industry such as construction, marketing, or manufacturing, etc. A project budget is not only a means to get things that your project requires. Yes, you need to pay teams, buy or rent equipment and materials, but that's only half the story. The other part of the importance of a project budget is that it's an instrument to control project costs. The budget, which is part of your project plan, acts as a baseline to measure your performance as you collect the actual costs once the project has been started. Budget and variance. Variance. Budget variance analysis is the practice of comparing actual results to the budget values for the same period and analyzing the variances. The budget is created to guide the business in accomplishing its goals and objectives. With this goal in mind, periodically measure how well the company adheres to it. Calculate budget variance. Budget variance shows the difference between budgeted and actual amounts, revenue or expenses. To calculate it for a category, subtract actual amount from budgeted amount. Variance equals actual budget. Positive variance equals favorable, spent less. Negative variance equals unfavorable, spent more. Reconciliation of accounts. Reconciliation is an accounting procedure that compares two sets of records to check that the figures are correct and in agreement. In accounting, reconciliation is the process of ensuring that two sets of records are in agreement. Most of the reconciliation are done internal versus external. Examples are material reconciliation, installed versus supplied, issued; work done reconciliation, certified versus progress; final accounts, total work done versus total certified. Project costing and profit analysis. Project costing consists of evaluating the costs and income of a project in order to estimate the total profit loss of its realization. SWOT analysis on projects. SWOT analysis in project management is a method that's used to assess a project's strengths, weaknesses, opportunities, and threats. It helps stakeholders identify which areas of a project to focus on, as well as potential risks to address in advance. Strengths, skilled manpower, availability of resources, etc. Weaknesses, poor planning and management, inefficient management of resources. Opportunities, project extension, additional variance, threats, disagreement with the client, possibility of backcharge or forfeiting the chasers, no likely chance of awarding new project due to improper management. Internal and external benchmarking. Benchmarking is a process that involves measuring the performance of your business against a competitor in the same market. This will give you a better understanding of your business performance and potential. External benchmark. Compare the project performance and strategies with competitor. Internal benchmark. Compare the project performance and strategies with competitor internally with existing or completed projects.